Hello and what is going on, lovely people of the internet? It is Hootmoney here with another video for you guys today. Today we're going to be talking about the T word. The T word that no one wants to hear, but we all have to deal with, and that is taxes. Tax season, baby. It's not quite tax season yet, but year end of 2021 is quickly approaching. We're now in December. It's December 1st. So I felt it was appropriate to make a video on tax loss harvesting. So there's a lot of you guys out there that invest in meme stocks, these highly risky, volatile assets that more often than not do end up going down in price. And a lot of people end up being bag holders on these stocks. Now, that's not all bad news. It's okay to be a bag holder. Want to know why? Because you can take those losses, those capital losses, and you can harvest them by selling them, making those unrealized losses realized, and then you use those losses to offset some of your capital gains. We'll be going over the whole strategy behind this throughout the video, and if you guys don't mind dropping that like on the video, subscribing for more, hitting that post notification bell, but most importantly, just dropping that like on the video. It's always highly appreciated. But without further ado, let's get right into it. So here we have tax loss harvesting from Investopedia. We'll go over the basics right here. Tax loss harvesting is the selling of securities at a loss to offset a capital gains tax liability. This strategy is typically employed to limit the recognition of short-term capital gains. Short-term capital gains are generally taxed at a higher federal income tax rate than long-term capital gains. However, the method may also offset long-term capital gains. So if you have bought any of these stocks right here, all of these wonderful stocks, you may be able to sell these stocks for a loss and then offset gains that you've made in another stock or cryptocurrency, or even just by flipping houses, right? Any type of asset that you've made capital gains on, you can offset those losses through selling your stocks for a loss. So DWAC, plenty of people bought this thing up here, over $100 per share. This is sitting at $40 per share right now. If you bought it for 100, you sell it for 40, you get to harvest $60. CEI, tons of people bought in back here above $2 or $3 per share. It's now sitting at $1.14. So you can also harvest these. Sundial Growers, this is another one. A lot of people bought in back here at 90 cents. It's now at 58 cents. A lot of people bought back in over here too in February when it was over $2 per share. And now it's at 50 cents. So you can harvest that as well. GameStop has held up pretty well. But still, a lot of people have bought in well over $200 per share. You can harvest these losses. SDC, another one, guys. You're starting to get the point. A lot of people bought in over here around $6. It's now under $3. You can harvest them. Vinco Shrinko, we all love this one, right? A lot of people bought in above $9 over here on the first run up, and even at like $6 or $7. This is now under $3 per share. AMC, this is another one. It's now breaking out of its long-term trend. Most people at this point are probably down on AMC unless you bought in for the initial pump up here. So this is another one where you can just harvest these losses, right? Progenity, all right? I know you guys still love Progenity, but a lot of people bought in back here, $5, $4 a share. It's now at $2.80. You can sell this stock and harvest those losses. All right, so how does this all work? Well, first you have to understand the difference between a realized capital gain and an unrealized capital gain, and then also with capital losses as well. So an unrealized capital gain is a stock that you bought and you are still holding, but you are up on that stock. It is not realized until you sell it for a profit. It's the same thing with losses, right? If you are holding a stock, or how some people call it, bag holding a stock, right? You buy Progenity at $6, it's now under $3, right? You haven't sold yet. That is unrealized, right? So this does not count for unrealized. In order to make it realized, you are going to have to sell that stock at a loss. So if you bought Progenity for $6 per share and you sell it for under $3 per share, or let's just say $3 for simplicity, you can get a tax loss write-off essentially for $3, because the difference between $6 per share and $3 per share is $3. So in 2021, if you realized capital gains of $5,000, meaning that you sold a stock for a profit of $5,000, and if in 2021 you also realized capital losses of $4,000, meaning that you sold a stock for a $4,000 loss, this would mean that you only have $1,000 of taxable income because the $4,000 offsets $4,000 of the capital gains, leaving only $1,000 left to be taxed on. So instead of paying taxes on that $5,000, assuming a 20% tax rate, you would pay $1,000 in taxes. Instead, because of the tax loss harvest of $4,000, your tax bill goes from $1,000 to only $200, which means that you are saving $800 by harvesting these losses. Alright, but what if you have more realized capital losses than realized capital gains? Your realized capital losses in 2021 are $5,000 and your realized capital gains in 2021 are $4,000. Well, you won't be paying any taxes on that $4,000, meaning that you can keep all $4,000 of those capital gains without paying any taxes. But $1,000 of those losses can get carried over to 2022, and you can carry over up to $3,000 in additional capital losses over capital gains each and every single year. So if your realized capital losses were $8,000 instead of $5,000 right here, you'd only be able to carry over $3,000 into 2022 instead of $4,000. And then in 2022, if you get $3,000 worth of capital gains, you won't have to pay any taxes on it. And what I was just describing to you is the tax loss carry forward rule. And then it says right here, capital losses that exceed capital gains in a year may be used to offset ordinary taxable income up to $3,000 in any future tax year indefinitely until exhausted. So this means that in 2021, if your realized capital gains are $4,000 and your realized capital losses are $13,000, that would be a $9,000 capital loss in excess of your capital gains, which would mean that you pay no taxes of capital gains in 2021, but $3,000 of those losses get carried over to 2022, 2023, and 2024. So you can't write off $9,000 in 2022, but each additional year you can add on another $3,000. So a $9,000 loss can be spread out over 3 years, $3,000 each year. All right, so the next thing that we have to go over is the wash sale rule, because if you sell a security and you buy it back within 30 days, that is considered a wash sale. So you don't have to pay any taxes on any gains that you make by selling that stock and buying it back in 30 days, but you cannot harvest losses by doing this. So if you have unrealized capital losses on a stock and you sell it, you can't buy it back within 30 days or on January 1st of 2022 in order to harvest those losses. It won't work because you just did a wash sale. So a wash sale invalidates the capital or the tax loss harvesting rule. This also means that you can't purchase a substantially identical investment, meaning that if you lose money on the S&P 500 or the SPY, so SPY, you can't just buy back VOO, which is another S&P 500 index fund. You can't just do that because that is still considered a wash sale because they are substantially identical. Now, in the case of these meme stocks, they aren't substantially identical, right? So if you wanted to take your money out of BBIG and put it into something like Progenity, that still works. And that brings me into the next point, that a common strategy for avoiding violating the wash sale rule is to sell an investment and buy something with similar exposure. So that would allow you to get similar returns on your portfolio while also taking advantage of tax loss harvesting. So long story short, if you do decide to tax loss harvest with one of these stocks, do not buy it back within the next 30 days because your tax loss harvest will be invalidated by the wash sale rule. Now, this brings me in to the crypto wash sale loophole. So the tax code prevents you from buying a substantially identical asset after harvesting for tax losses. We just went over that, right? Meaning that you can't sell SPY for a loss and buy back VOO because they're both S&P 500 funds. Correct? Well, crypto does not have this rule, meaning that you can harvest losses in crypto and then immediately buy back that crypto asset right afterwards. So if I lose $5,000 on Bitcoin, I can sell it, right now, and then I can buy it back immediately, and I still get to harvest $10,000, or did I say 5,000? It doesn't matter. I still get to harvest those losses against my capital gains. And then the last thing that I wanted to go over is that if you lose money in stocks, you can write off losses against your crypto gains. So if you lose $5,000 in stocks, but you make $5,000 in crypto, you do not have to pay taxes on any of your crypto gains, right? Because you harvested $5,000 of losses. Goes the same vice versa. If you lose money in crypto, you can write off losses against stock gains. So that's all I really got here for tax loss harvesting. If there's something you don't understand, feel free to watch this back a second time or leave a comment down below. I will try my best to respond to any questions. Before we go, if you guys wanted to check out Moomoo, you can get essentially free money up to $3,500 in free stocks. And if you deposit $2,000 on their platform, you can get 3 stocks, which each of them valued up to $3,500. So this is the best brokerage promotion that I have seen so far, and you probably, if you like free money, you should check it out. All right, so the links are below in the description or pinned comment section. All you got to do is deposit $1 single on their platform. Anyways, guys, that's about it for the video. I hope you guys have enjoyed. As always, I enjoyed making this one. It is tax loss season. I am a bit afraid that some of our favorite meme stocks, short interest stocks, highly shorted stocks, whatever you guys want to call it, might actually continue to sell off, because a lot of them did not actually end the year on some good performance. I mean, just looking at what we were looking at today, they're all down pretty much like 7 to 15% on today's date alone. So this might be the start of tax loss harvesting season, as it is December 1st. So this is just something that you guys should keep on your mind anyways, right? If you guys enjoyed the video, drop that like before you guys leave, subscribe for more content, hit that bell down below. We go live looking at the stock market and cryptocurrency each and every single day here on this channel, so make sure that bell is tapped so you never miss a beat here on this channel. That's all I got, guys. Check out Moomoo if you guys haven't already. Links are below, and I will be seeing you guys next time. Peace.